Thank you, Mr. Chairman, and thank you, Mr. Chairman, for being here. My top concern is actually exactly the same as Mrs. Warren's, and I think that is a statement in and of itself that there is growing bipartisan concern across the whole political spectrum about the fact, I believe it's a fact, that too big to fail is alive and well. First of all, in terms of the study, Ms. Warren cited the Bloomberg calculations, but that's clearly not the only thing out there. There's an FDIC study released in September that concludes that, quote, the largest banks do, in fact, pay less for comparable deposits. Furthermore, we show that some of the difference in the cost of funding cannot be attributed to either differences in balance sheet risk or any non-risk-related factors. The remaining unexplained risk premium gap is on the order of 45 basis points. Such a gap is consistent with an economically significant too-big-to-fail subsidy paid to the largest banks, close quote. In addition, an IMF working paper has attempted to quantify this subsidy, and it said the subsidy, quote, was already sizable, 60 basis points, as of the end of 2007 before the crisis. It increased to 80 basis points by the end of 2009, close quote. Then we have the Bloomberg quantification, which was working off that IMF work that was mentioned, and also a board member, Daniel Tarullo, who says, quote, to the extent that a growing systemic footprint increases perceptions of at least some residual too-big-to-fail quality in such a firm, notwithstanding the panoply of measures in Dodd-Frank and our regulations, there may be funding advantages for the firm which reinforces the impulse to grow, close quote. So my first point is not just one, outlier study. Given all of that, what specifically is in process in terms of regs or should be put in process to counteract that? Because my concern is, even if this problem is solved 2 years from now, the entire landscape of American banking will be different by then, including a lot of solid, smaller firms gone. And I think that's a real loss to our financial system.
There's a three-part plan under Dodd-Frank. Part number one is to impose costs on large institutions that offset the benefits they get in the funding markets. For example, capital surcharges, activity restrictions, liquidity requirements, living wills, a whole bunch of other things that impose greater cost and force the largest firms to take into account their systemic footprint. That's number one. Number two is the Orderly Liquidation Authority, which we're working closely with the FDIC and with our foreign counterparts to figure out how we would take down a large institution without bringing down the system. And part three is a whole raft of measures to try to strengthen the overall financial system so that it would be more credible that we could take down a large institution without bringing down the system. That's sort of the three-part plan. It's working to some extent. For example, even though U.S. banks are stronger financially than European banks, frequently U.S. banks have wider credit default swap spreads, indicating a higher probability of actual failure because the differences between the U.S. and Europe in terms of perceived government support. So that's the process, that's the plan. There have been additional ideas such as, essentially doing Glass-Steagall again, separating the commercial banking and investment banking activities. We're doing that to some extent, for example, with the Volcker rule, but I don't think that Glass-Steagall by itself really would be all that helpful because, after all, in the crisis, some of the firms that failed were straight investment banks and some of the firms that were in trouble were straight commercial banks. So I'm open to discussing additional measures, but the plan is to impose costs on the largest banks, to make them internalize their systemic imprint, to develop a liquidation authority, and to strengthen the overall system. And over time, that ought to improve the situation. But if it doesn't, I think we ought to consider alternative and additional steps.
Well, I would, in closing, I would really continue to encourage you all doing that now. And again, I think this is a bipartisan concern. I've expressed this concern and several ideas, for instance, with Senator Brown on the committee. The three components you described are understood by the market. In my opinion, they've been digested and valued by the market, and the market still says there's too big to fail. In particular, I would continue to urge you to revisit higher capital requirements beyond the marginally higher requirements that you have instituted so far for mega banks. And I would continue to urge y'all to think of alternatives to Basel III as well in the same spirit. Thank you.
Thank you, Senator.